Welcome back to Business Ethics. My name's Tom, and in this unit, we're going to talk about some major pieces of legislation and a little bit about how legislation factors into business ethics. So, the major pieces that we really focus on in this unit are the SOX Act and Dodd-Frank. The midterm paper will have to do with these. There are two articles that are available. One is on SOX Act and one is on Dodd-Frank, and they're both somewhat critical of these pieces of legislation, and but in a fairly nuanced way. And part of the midterm paper will be just to spell out what that nuance is. So I want to first just talk about why we would talk about laws in an ethics class a little bit more closely. Um, it's important to remind ourselves that ethics and laws are different, right? You study ethics, you can study law, these are different things, right? And part of how these come apart conceptually is very simply that we can think that laws are unethical, right? Or we can think that there aren't laws that represent the ethics that we all, kind of share, right? So that there should be, this is how oftentimes we introduce new pieces of legislation, or we remove other pieces of legislation, or we modify them, right? Our um, our ethical sensibilities can really kind of push the way the law unfolds and how it manifests in our society. Okay. So, but so why are we talking about that? If we're talking about business ethics, why are we talking about the law? Well, one is by looking at the laws or important laws, it can give us kind of a beat on public opinion, right? So if you look at the history of legislation and how it has changed and the kinds of pieces of legislation that have emerged, this gives you a sense of kind of like where in the business industry is going, right? What public opinion is on business and how they operate. It gives us also, in the same sense, kind of a history of moral progress, right? What does it look like? What were, the restrictions on business 100 years ago? What did they look like? And it also, importantly, if you are actually putting together an ethical program or a code of conduct or something like this, the laws and legal compliance are kind of like your starting point. We'll see this as we look at like some codes of conduct. I mean, they'll say at the outset, first and foremost, our company wants to follow the law, right? Like you shouldn't break the law at our place of business. I mean, you have to say that to a certain extent, but that's just kind of like the lowest bar. And then your ethics program is going to be that plus whatever else you want to do in addition to that, usually. So just as far as the first 2 points that I just made in terms of like giving us a beat on public opinion and a sense of history of moral progress, I think a very stark example of this that I always like to mention is the 1833 Factory Act. I believe this is in the UK, but anyways, there were a series of pieces of legislation at this time in the Industrial Revolution, and at that time, these big companies and factories were just working people for very low wages, working them sometimes 24 hours a day. If you want to look up working conditions in factories in the early 1800s, it's quite interesting. But basically, one of the first pieces of legislation to kind of restrict or put in place a labor law was this Factory Act, and it was focused on child labor. And the restriction was that no workers under the age of 9 could work in factories under the age of 9. Right? Employees had to have an age certificate for the child, so you had to prove your kid was over 9 so that they could work in the factory. Children 9 to 13 could work no more than 9 hours a day. Children 13 to 18 could work no more than 12-hour days. and children are not to work at night. They were required to have 2 hours of schooling for kids, all these kinds of things. So um, if this has to be put in place, kids were working probably like 15, 16-hour shifts, right? It also doesn't say anything about weekends. No, there's no days off that they're required to give. Now, to us, this sounds rather appalling, right? We're like, oh my God, you got a 9-year-old in your factory working, 12-hour shifts. That's crazy. But that wasn't really the viewpoint at the time. In fact, a lot of the factory owners, when they saw this piece of legislation, they were, you know, like extremely angry. They thought this was taking money out of their pockets. This is going to put them out of business. They had much the reaction that lots of businesses have anytime any kind of restriction gets put in place. So this, if you compare that to things like, our current 40-hour work week for someone who's 18 or older, that's a lot of a big moral gap there, right? So this is just a good example of to kind of follow the laws and kind of get a sense of where we're at and what our ethical norms are and how they apply to business. So anyways, in a more of a technical sense, when it comes to recent kind of ethical programs and how we kind of dice things up, um, they mentioned three kinds of programs or practices in the book. They talk about voluntary practices. Um, there are also, those are just kind of practices that you don't need to do. They're not necessarily expected of you as a business, but you can do that. So, philanthropy is an obvious example of this, but also, things that are, what would you say, kind of pushing the envelope in terms of what's expected of a business, and maybe paying your workers more than what is average, or adding in little niceties in terms of, like, offering snacks and all kinds of things. This has become very popular. Core practices are, industry-wide standards. They're not laws, but they're things, that is kind of expected of any kind of business. So, like I mentioned before, like the snacks and all this kind of stuff is starting to become an industry-wide practice in a lot of tech firms. It's kind of expected that you have, food on hand, and you have, a space to eat, and places to, like a break room, this kind of thing. Break rooms not necessarily, I don't think it's required, but a lot of places just have it. So those are kind of examples of core practices. Things like free estimates, if you're a contractor, and a lot of businesses, that's become a core practice. You don't have to do a free estimate if you're giving someone an estimate for like hail damage on their roof, but that's pretty much what everyone does. And then mandated boundaries, these are laws, basically, things that you have to follow. If you want to run a business, you want to keep your license, you've got to do these things, right? Now, in terms of laws, one thing that we should mention are what are called pro-competitive pieces of legislation. Right? Pro-competitive legislation is basically legislation that is intended to prevent monopolies and encourage competition, right? So, sometimes the government wants to break up large companies because they think that it's moving towards a monopoly, it's squeezing out competition. And the idea is that, the lack of competition is bad for other businesses and for consumers, right? If someone has a monopoly, then they can charge whatever they want, they corner the market, and that is not good business practice, and it's not really a good use of capitalism, right? So when it comes to SOX Act and Dodd-Frank, these are both examples of pro-competitive pieces of legislation. They're laws that are intended to kind of create a fair and even playing field among companies, and also, to prevent unfair advantages, things that would typically be illegal. But So, one thing to mention, and we'll talk more about this, is when it comes to these kinds of pieces of legislation, when it comes to like big companies, um, federal oversight or any kind of governmental oversight becomes very complex. And this is part of there's a reading for this week that I think has to do with the discussion forum, and it has to do with a piece of legislation and to what extent it's really effective, right? So when it comes to big companies, just putting a law in place is usually not sufficient. So, for example, if you don't make that much money, you are much more likely to be audited than someone who's rich. And the reason is because if you are poor, your taxes are easy to get through, right? Um, and if you are a billionaire and you have all different companies and you have your money in CDs and all kinds of investments and stuff like that, it's very difficult to know where your income is coming from and how much it really is. And if you have the technical expertise to be able to go through a billionaire's tax forms, you probably are an accountant for a billionaire and not working at the IRS, right? So this becomes a huge issue when it comes to all kinds of different legislations that or pieces of legislation that really are supposed to govern or restrict large companies. So let's turn to first SOX Act. So this was in 2002, and it's federal oversight of corporate accounting practices, and it was a response to some widespread corporate accounting scandals at the time, right? And previous to it. So there are basically three parts to it, and a lot of this has to do with what I was just mentioning, has to do with implementation, right? It doesn't matter if you have a law on the books if you don't have a way to enforce it, right? So first of all, they had an accounting oversight board. You need experts that are able to kind of think about who you're going to investigate, when you're going to investigate them, what kind of practices are going to be effective, all these kinds of things. Um, Another component of this is auditor and analyst independence. And I put in my notes a mechanic problem. So the mechanic problem is basically the problem that when you take your car to a mechanic, and if you don't know anything about cars, and that mechanic says you need X, Y, and Z done, you're also paying them to do the work. And so everyone is always suspicious that the mechanic is making up things that are wrong with your car that cost a lot of money, right? And there's a certain opacity about what's going on there, right? And oftentimes you would want someone who's an independent party, a third party, to be able to look at it and tell you, yeah, actually, this is right. These things are broken, and it really is going to cost this, right? Um, so for companies, what they were doing in terms of accounting was having the person who's the auditor, the person who's finding errors or issues with your accounting, is also the person who's fixing those problems, right? And so they thought, the government thought this is really bad practice. You shouldn't have someone going through your accounting and telling you when there's problems and then telling you when they fixed them, because they're basically, there's no way to kind of balance those different tasks, right? So same person who's telling you're overspending is the same person you're going to pay for, trying to fix that. So, so that was one other component, and the last component is whistleblower protection. And this is the idea that you have protections in place for someone who wants to go to the government and report fraudulent accounting practices, right? Now, this comes up in Dodd-Frank as well, and we'll talk about that in a second. But again, just having some kind of protection saying, the government's going to make sure that no one, comes down on you for blowing the whistle, does not mean that people won't find a way to get around it to, you know, um, throw some kind of punishment your way, right? They might say they fired you for a different reason or what have you. So you need teeth to these policies, right? So Dodd-Frank basically is in 2010. It's a response to the financial crisis of 2008 with the housing market and everything, and um, in a lot of ways, it kind of revamps aspects of the SOX Act and kind of redoubles the government's efforts to have some kind of regulations on rather large businesses. So again, they have three parts. They have a financial stability oversight committee. Again, you have a committee that's going to, um, make sure that practices are not predatory. So in particular, they're focused on, there's consumer protections here. There's a Consumer Financial Protection Bureau that gets put into place. But a lot of this was about protecting consumers from getting, what would you say, misled, exploited, subtly misled, right, and taken advantage of in loan processes. And again, so then the third component here is the whistleblower bounty program. So they wanted to put this bounty in place to put some more teeth on the whistleblower protection that they had in SOX Act. So this is the idea that if you report that there were, someone at your company's embezzling funds, then you would get X amount of dollars for reporting that. And that's supposed to kind of soften the blow here. But again, it's hard to say how effective this is going to be. If you are at a major financial firm, you might make, high six figures, right? And if the whistleblower bounty is like, 200K, then that's not very much for you and your lifestyle, right? And also, the kind of consequences you might suffer from going to the federal government and reporting such things might really tarnish your reputation. It might make you not able to work in that industry anymore. And although there are federal protections that say that people can't fire you for being a federal whistleblower, they can kind of de facto just edge you out of the business, right? But it's an interesting component, and it does show how you need to have um, uh, these prospects for implementing these policies, right? And so when it comes to the midterm paper, they will be looking at these things and to what extent they're really effective and to what extent they really do what they say they're going to do, these pieces of legislation. And so that's it for now, and I will see you soon. All right.